Thanks a lot for everybody for taking the time out and to attend this webinar. First of all, I'd like to welcome you and the Lubbock Fine team. Introduce myself first of all. If we could just go to the next slide, please. I am managing partner for Holborn Assets here in the Middle East. My name is Alex Herbert. As you can see, we operate in 18 international countries, plenty of staff, over 500 staff, and with over 2 billion under management. I'm the managing partner here in the Middle East. If we go to the next slide, you'll be able to see a better picture of me. That's in my younger years. I suppose the reason why we've come to this and why a lot of people have been asking us these questions is because of the ongoing situation in the Middle East. A lot of our clients have asked us a lot of what if questions. So, for example, what if I have to return to the UK? What if I choose to return to the UK? And what if I go back and I maybe come back to the Middle East in September and in the start of the new school year, etc. And what are my tax consequences for doing so? So we've reached out to Lubbock Fine. Lubbock Fine are a leading tax consultancy in the UK. And we're joined here today by David and Nicole, who's going to be taking us through a number of different slides and will hopefully be answering plenty of questions that you guys have. As we're going through the slides, I'm sure there'll be plenty of questions. If you could just use the Q&A at the bottom of your Zoom screen, that'll be great. And then we'll handle those questions at the end. So guys, I'm happy to pass over. Thanks a lot for doing this for us. I will pass over to David initially, and I'll see you all again at the end. Thanks a lot.
Thanks, Alex, and thank you everyone for joining. So I'm David Portman from Lubbock Fine Accountants, and my colleague Nicole here is with me, and I'll pass on to her later on. So first up, a bit about Lubbock Fine. We're a full-service accountancy practice based in London and Dubai. We've been around for nearly 100 years. We have 21 partners and around 200 staff, and we support businesses and individuals across the UK and internationally. As Alex mentioned, today's session will be covering the UK tax residency issues, and this is very relevant at the moment given the war and people spending more time in the UK. So we have the agenda here, and today we'll be highlighting the rules, covering the potential pitfalls, and then the planning opportunities that are available to people. As you'll see as we go through things, a lot of these points require some quite in-depth analysis, and the devil is always in the detail. So please do get in contact with us after the webinar, and we'll be happy to assist you. So first off, we'll cover how the rules work and then get into some of the detail and planning opportunities later on. If we could have the next slide, please. So to start, we're looking at the domestic UK rules, which determine whether an individual is resident in the UK or not. The rules are set out in the legislation called the Statutory Residence Test. These are a series of tests which review and decide your status. You go through each test in order and each question in turn until the criteria is met, and then you stop at that point, and that determines your position. The first part is the automatic overseas test, which if met means you are then automatically overseas or non-UK resident. The second part is the automatic UK test, which if met, you're automatically UK resident. And finally, if neither of those are met, you determine your status under the sufficient ties test, which is based on a sliding scale of UK days and UK ties. So next slide, please. So now if we quickly run through these tests. So the 3 overseas tests are shown here on the slide. As you can see, broadly, if you limit your UK days, then you could be non-resident, or if you can fulfil the requirement to be working full-time overseas, then you'd be non-resident under that basis. So just to add here, anytime we're talking about UK days, a day is a UK day for this purpose when you're in the UK at midnight, although that is subject to certain deeming rules. So if you get the next slide, please. So if you don't meet any of those previous tests, and you go to the UK tests, which are shown here. So either more than half the year spent in the UK, you have an only home in the UK, or full-time work in the UK. So the full-time work in the UK could catch a lot of people moving in or out of the UK, as you can see there, because it's any 365-day period where there's 1 day in the tax year. But we will come on to split year later, which could potentially apply in those circumstances, but that's just something to watch out for. Should also be careful of the home test, but that can generally be avoided if you keep, maintain and use an overseas home. So if neither of those tests are met, so the overseas test or the UK test, then you'll come on to the next slide, which is the sufficient ties tests. And broadly, as you can see here, the more ties you have to the UK, the lower your day count will be in order to be non-resident. The only ties listed in the legislation are listed here. And interestingly, the family tie also includes unmarried partners if they are living together as husband and wife or as civil partners. So again, that could catch people out potentially. The work tie, again, interestingly, is any day in which you undertake more than 3 hours of work. That's 3 hours of work physically in the UK, either self-employed, employed, director of a company, either remotely or in an office somewhere. So next, I think we'll take you through a quick example. So we have a couple living in Dubai with 3 children, and they've lived there for 5 years. The wife and children come back to the UK and live in a rental property. You could use this as an example to people currently, maybe move back to the UK for schooling or something like that and living in a rental property for the time being. But the husband is still traveling overseas and works in and out of the UK. So how many ties would the husband have? So first off, we're obviously assuming he doesn't meet the overseas or the UK tests. Otherwise, he would meet one of those and we wouldn't get to the ties test. But assuming he doesn't meet those, then we look at the ties. If we say accommodation, almost certainly be met as he has accommodation available, and if he makes use of it, then that will count. Family tie, probably, obviously require further analysis, but if his wife is UK resident and the children, then that will apply. Note, if the husband and wife have the same travel pattern, then potentially you can disregard the family tie because you effectively can't sort of rely on the other one to trigger the tie. But that doesn't seem to be the case here. And work. So potentially, if he works in the UK for more than 3 hours on at least 40 days, but again, it will require a bit more analysis to determine that. So how many days could be spent in the UK as an arriver? So being an arriver as he hasn't been UK resident in the prior 3 years. So if he has 2 ties, so we're accepting 2 ties being accommodation and family, probably, then up to 120 days maximum in the UK and still be non-resident. Or if he has 3 ties, so accepting those 2 plus the work, then up to a maximum of 90 days. But here it just shows an example of you really need to understand the fact pattern in advance and then stick to it. Because you could possibly plan on having 2 ties, and then you could be in the UK for up to 120 days max. But if you're trying to avoid meeting the work tie, then there's quite a high number of days in the UK to not be working. So you just really need to think about it at the start and the risks around that. So if we could come on to the next slide, please. So here we're going to be talking about exceptional days. So these are days in the UK that can be disregarded when counting your UK days or midnights, as we mentioned. So up to a maximum of 60 days per tax year can be disregarded. So what counts as exceptional? So the rules state this can apply when you're in the UK due to exceptional reason beyond your control and you are prevented from leaving the UK. And then you must leave the UK as soon as those circumstances lift and permit you to leave. The HMRC guidance around this does include notes on war, and specifically regarding the Ukraine war, it says individuals returning to the UK would qualify for days spent in the UK to be disregarded due to exceptional circumstances subject to the 60-day limit. So if you returned to the UK, so that's slightly different to prevented from leaving, then those days could be disregarded, obviously subject to the 60-day cap. There is no new guidance for the Iran war, and at the moment, the HMRC guidance still refers to the Foreign and Commonwealth Office guidance on travel, which is slightly different if you compare UAE to Ukraine. Ukraine states avoid all travel, but UAE states all but essential travel. Therefore, there is a risk that HMRC do not accept exceptional circumstances claims, but this really needs to be reviewed on a case-by-case basis. It's also worth noting that it's not all UK days for the purposes of the legislation, obviously subject to the 60-day, but it does not include also the UK test for home, and it does not cover any work days whatsoever. If obviously you did return to the UK due to the Iran war, and you're still here, or you're here for a period of April, you probably really need to review that situation for the current tax year, and then possibly adjust your future plans, maybe assuming those days are going to be counted. There's no sort of pre-approval with HMRC at the moment about this, so you really need to be careful. So finally, we cover split year treatment briefly. So this can apply to people coming to or leaving the UK partway through a tax year. So this allows you to split a tax year into UK or non-UK resident periods. You need to meet one of the cases listed here to obtain this treatment. Nicole will come on to the planning options more widely in a moment, but for those coming back to the UK, more generally, you'd probably want to ensure you remain non-resident for as long as possible, i.e. the next 5th of April, to then obtain the maximum benefits under the FIG regime, as that applies to the first 4 UK tax years you're resident, and split years count as a full year. Also, often split year affects the following year. For example, on leaving the UK, a split year on exit under the starting to work full-time overseas case means that you need to be non-resident under the automatic overseas tests working full-time abroad for the following tax year, which can be quite limiting for people in terms of UK work days, which is capped at 30. So again, just something to be wary of, and planning in advance can be very beneficial to avoid being tripped up later. So thank you. I'll pass you over to Nicole to cover some further information and planning opportunities.
Thanks, David. So the first thing that I wanted to mention is, even if you do become UK resident under one of the residence tests that David's been talking about, there is a possibility that you could still be taxed as a non-UK resident if you're still spending enough time in the UAE to remain resident over there domestically under their domestic provisions. So in that situation, what happens is you could be dual resident, so resident in the UK under our rules, resident in the UAE under their rules. And in those circumstances, we then have to look at the provisions contained in the double tax treaty between the UK and the UAE. And go through a series of tiebreaker tests to determine which country your residence falls to. And if under those tests your residence falls to the UAE, you could then still be taxed as a non-UK resident. So it's worth bearing in mind. As I said, that there's two circumstances or two conditions that need to be met. So firstly, you still need to be resident in the UAE. Secondly, under the tests, your residence needs to fall to the UAE. So what are the tiebreaker tests contained in the treaty? Well, there's 4 tests which are set out in the slide. We consider the tests in order, and as soon as you've determined residence under one test, you don't need to look at any of the other tests. So the first test is where you have a permanent home. So if you have a permanent home in one jurisdiction but not in the other, your residence would fall to that jurisdiction. If you have a permanent home in both countries, then we move on to the second test, which is the centre of interest test. And that looks at where your family connections are, your business interests, employment, financial interests, etc. And if that could still be considered to be in the UAE rather than the UK, then your residence status would fall to the UAE and you would be taxed as a non-UK resident. Normally in these cases, your residence would be determined under one of the first two tests. It's kind of quite rare that we go to the other tests, but the other tests are habitual abode, which looks at where you're spending most of your time. And if residence can't be determined under that test, we then move on to nationality. So it can be helpful in certain cases. It is very much dependent on your specific circumstances. So next slide, please. So if you want to be sure that you're non-UK resident under our residence rules that Dave has just gone through, there's a few steps that you would need to take. So first of all is understand your ties to the UK and manage your day count according to those ties. So this would assume also that none of the automatic tests are met. It's particularly important to watch out for the only home test. So if you meet the only home test, David said, you're automatically UK resident. So that's regardless of how many days you've actually spent in the UK. And that can be triggered if, for example, you come back to the UK, you have a home in the UK, maybe you've been renting in Dubai and that rental agreement ceases, and you have a home in the UK which is available to you for more than 91 days. Now, you may not spend all the time in that home, but if that home is available to you and you have no overseas home, then there is a risk that you could trigger one of the automatic residence tests and be automatically UK resident. So that's one to watch. We also recommend that you keep a travel schedule showing where you are on each day of the tax year. So that would be days of presence, and also it's helpful to have work days, so where you're actually working on those particular days, so that you can then accurately see as we go through the tax year how much time you're spending in and out the UK and whether you're getting close to any UK day count limits. Travel schedule is also important in case HMRC want to look at your position, and then you have a document or one document that can quickly kind of justify where you've been. Doesn't mean to say they wouldn't ask for other documents, but it can be very helpful to keep a travel schedule. So the risks, as I said, you know what ties you have to the UK, and then ensure that you limit your number of days spent in the UK, and you don't go over the maximum depending on the number of ties you have. So if you have a spouse in the UK, and as David said, that can include a civil partner or an unmarried partner, or your children are simply attending perhaps boarding school in the UK, then that can create a family tie. Also, if you're working in the UK for at least 40 days, that can create a work tie. And as David said, a work day is any day on which you've worked for at least 3 hours. So it doesn't have to be a full day of work in the UK. If you're visiting the UK regularly, but you don't have accommodation, your own accommodation here, you're perhaps staying in hotels, but you occasionally stay at a relative's house, you again have to be a bit careful, because once you've spent 16 nights there, that will give you an accommodation tie, even if you don't have your own accommodation in the UK, or you don't have a rental property in the UK. One other thing to watch is this 90-day tie. So where in one of the previous 2 tax years you've spent more than 90 days in the UK, that will give you a 90-day tie for the following 2 tax years. So that's something to watch as well. The ties can get quite complex, and it's not necessarily easy to determine exactly what ties you have. So we can look at those for you. And next slide, please. So if you do trigger UK residence, it's not necessarily terrible. There are things we can do to ensure that we minimise as much as possible any UK tax liabilities. So the first thing we look at is if you're eligible for what's called the foreign income and gains regime. Now, this is quite a beneficial regime. It was introduced in April last year, and it will exempt most overseas income and gains from tax for the first 4 years of your UK residence. So it doesn't exempt all overseas income and gains, so we need to look just to check that what you have qualifies for exemption. And in order to be eligible for this regime, you must have been non-UK resident for all of the previous 10 UK tax years. So you won't be eligible if one of the previous 10 tax years you've been a UK resident. So we'd need to look back 10 years, check that there's no residency in those 10 years, then you qualify for FIG. Employment income. So if you're working overseas, so UK resident but still working overseas, you have overseas work days, any income that's attributable to those days can also qualify for relief under the new regime, but it is capped at the lower of 30% of your total income for the year, or £300,000. There's a maximum relief of £300 there. And if you elect to be within the FIG regime, one downside is that you will lose your income tax personal allowance in the UK, and you'll also lose your capital gains tax annual exemption, which at the moment is only £3,000 per year, so it's probably not worth worrying about too much. One point to mention is that if you do qualify for FIG regime and you have overseas income and gains that are exempt from UK tax, they do need to be reported on your tax return. So we need to itemise each source of income and declare on your return how much income is qualifying for relief. So there's full transparency for HMRC. But it can be quite beneficial if most of your sources of income or gains are outside the UK for those first 4 years. Next slide, please. So there are some risks. If you do become UK tax resident, we'll just need to check that whether any of these risks apply, and if so, what we can do to kind of minimize tax exposure. So the first thing that we'd look at is, when you come back to the UK, have you only been non-UK resident temporarily? And what that means is a non-residence period that spans 5 years or less. So if you left the UK within the last 5 years, you could fall within these rules and be regarded as temporary non-resident. So the impact of being a temporary non-resident means that when you come back to the UK, you might be liable to UK tax on any capital gains that have been realised whilst you're a non-resident, or if you've received any dividends from any close companies during that period of time, and that includes both UK and non-UK companies. So we need to just check whether those rules will apply, and if they do, perhaps see whether we can mitigate them in any way, or perhaps if you're just coming up to 5 years of non-residence, maybe we can extend your non-residence period for a while so that you don't become UK resident, fall within these rules. The other thing to watch out for is your IHT exposure if you come back to the UK. So IHT liability will be on worldwide assets if you are long-term resident in the UK. And that means if you have been resident in the UK for at least 10 out of the past 20 UK tax years. So we look back 20 years. If you have been resident for 10 years, you'll be regarded as long-term resident, which means that then IHT is chargeable on your worldwide assets. So it's something to watch out for. There's always IHT planning that can be done if you do fall within the long-term residence rules, but it's something you do need to be aware of so that you carry out the appropriate planning. The other point to mention on IHT is that once you trigger long-term residence, so once you become a long-term resident, when you then leave the UK again, you have what's called an IHT tail. And this is a period of time after you've left the UK when you're still considered long-term resident. Now, the period of time will differ depending on your circumstances, but it can be up to 10 years. So even though you might have left the UK again, there can still be IHT exposure on worldwide assets if you have become long-term resident when you're in the UK. It's just another thing to be aware of. So for people who might be running a company outside the UK that's currently being run outside the UK, non-UK resident company, then to the UK, we have to look at whether that changes the management and control of that company. Particularly in the cases of maybe husband and wife company, perhaps, or family company, and family members or both husband and wife come back to the UK and they're the ones making decisions on behalf of the company. That could mean that the company is then managed and controlled from the UK, which would mean that it would fall into corporation tax. So profits would then become liable to UK corporation tax. So something to watch out for. There are steps you can take, possibly to try and maintain management and control outside the UK. So a permanent establishment is the other thing that we need to just check for, that there's no risks here. So this is where you have a non-UK company that's managed and controlled outside the UK, but might have what's called a permanent establishment in the UK. So a permanent establishment is normally triggered by two means. The first means is that if the company has a fixed place of business in the UK. So if you're in the situation where you are now having employees or a close family company, the directors have now come back to the UK, you might have a fixed place of business in the UK. You might even have offices, but you might be working from home. That in certain circumstances, that could still trigger a fixed place of business in the UK. What's the consequence of that? Well, it means that any profits attributable to that fixed place of business will be within the charged UK corporation tax. The other way that a permanent establishment can be created is where a director comes to the UK and has the authority to conclude contracts on behalf of the overseas company on a habitual basis. So if a director is in the UK concluding contracts here habitually, then that in itself could give rise to a permanent establishment in the UK. So these are things that we can watch out for and then advise you on how to avoid if necessary. And I think David mentioned also that there is a risk if you've claimed split year. So for people who may have left the UK last year, if anyone's in that situation, and that year was a split year for residence purposes, if you now come back to the UK this current tax year and become resident again, your split year last year could be invalidated, which would mean that you'd be UK resident for the full year rather than just part of the year. So that's something to watch out for, because that would have UK tax implications as well. Next slide, please, Robin. So if you are planning to come back to the UK and you think you're going to become resident in the UK, then there's lots of planning opportunities, and we can look at this for you. So firstly, if you're a non-British national, you should check visas and immigration status. That goes without saying. We would also look at your assets, such as financial portfolios, any other assets you might have, and check whether they're UK, non-UK situs. So this could be important if you do qualify for the FIG regime. You might want to move any UK cited investments outside the UK so that they qualify for relief from UK tax, the income and gains arising on those investments. We'd also review any current structures just to check that they are viable for UK and they don't incur any adverse UK tax consequences. So this would include trust structures. So if you're a settlor or beneficiary of an offshore trust, there can be implications when you become UK resident. We would look at any family investment companies. And again, this would also feed into things like management control and permanent establishment. You might want to, if you've got assets that are currently standing at a gain and have a large inherent gain, you might want to look at realising those gains before you become UK residents so that the gains can be realised tax-free for UK tax purposes, so accelerating disposals. There are a couple of watch points here. So the first is that it wouldn't work if you're a temporary non-resident. Secondly, depending on the jurisdiction where those assets are, there could be overseas tax implications. We'd also need to check whether split year treatment applies in the year you come back to the UK. And because if there's no split year treatment, then even if you're realising the gains before you become UK resident, before you return to the UK, if you're UK resident for the full year, then those gains could be caught even if the disposal takes place before you actually come to the UK, if that makes sense. The other thing to think about is possibly accelerating dividends, if this is possible, where you have the opportunity to do this. From either a UK or a non-UK company, there is a difference here, though, between UK and non-UK companies. So dividends taken from a UK company do not benefit from split year treatment. So if you take a dividend now, but you come back to the UK and become resident in the UK from, say, July, then any dividends taken from a UK company now will still be subject to UK tax, because even though you might get split year, that treatment doesn't apply to UK source dividends. So it's, again, things like this are potential risks that you need to look out for. Even if you do become UK resident, there's loads of things we can do in terms of planning. So we can look at planning between couples. So we do have clients in situations where one spouse is UK resident, the other is non-UK resident, and we can look at planning between spouses. So, for example, transferring assets to the non-UK resident spouse. Or if you're both UK resident, then we'll still look at perhaps equalising income between you so that one of you isn't paying tax at 45% and the other one not using up any allowances or lower rate bands. So there's always things we can look at, even if you do become resident and even if you're not eligible for the FIG regime. The other thing to note is employment. So you might now be spending more time in the UK, you might be working in the UK for longer periods of time. If you're working for a non-UK company, we just have to check whether there's any UK payroll requirements, because you're now working in the UK for a longer period of time, and also where liabilities to national insurance contributions would arise. So again, these are all things that we would look at as part of an overall review. We always suggest that you plan as early as possible before moving to the UK so that we can maximise the opportunities to save tax, and we can minimise any tax risks for you. So that's it from me. I'm going to hand over back to Alex now for the Q&A session.
Yeah, thanks, Nicole. That was excellent. And thanks, David. I think the one thing that stood out for me there was the reliance we have on experts such as you guys. Taking professional advice, whether becoming non-UK resident or returning to the UK, is incredibly important because there's plenty of information and plenty of pitfalls by the looks of it. As we were going through, we did have a number of questions, so I'm just going to fire through a couple. Simon asked, and it was actually something that I made a note of as well. What is the definition of a work day? So if you're in the UK and working over 3 hours, but on non-UK work-related issues, does that still count as a work day?
Should I take that one then? Yeah,
please. Yeah.
If you're physically in the UK and working, then that counts as a work day. So yeah, even if you're working for an overseas employer or for an overseas company or what have you, if you're physically in the UK, then it does count as a work day, unfortunately. But that, as we mentioned, it's only over 3 hours. So potentially you may be able to limit work on certain days to avoid triggering that possibly.
Okay, great. And the one that came to my mind was, if I'm sat back in the UK and I'm visiting the UK and I'm, on my emails, which I am pretty much all day, every day, I'm assuming that would constitute as a UK working day. And I'm just replying to emails.
Yeah, exactly. Yeah, it can count as a work day. Yeah, it depends obviously the amount of time involved.
Okay, great,
yeah.
Great. Okay, we've got a question here from Romeo, who works with us down in South Africa. So he's got a client. He's been residing in the UK for 4 years. Now, due to changes, he spends 6 months in the UAE. This is going to be complicated. 3 months in South Africa and 3 months in the UK. So 6 months UAE, 3 months South Africa, 3 months UK. He has a home in the UK, a home in Dubai, and a home in South Africa. On this basis, will his tax residency change to the UAE, or is he still at risk of being a UK tax resident? Wow. Who wants to deal with that one?
Will I tackle that one? Yeah, so we have to go through the steps here. So the steps would be, under the UK domestic residence rules, do you meet any of the tests? So you wouldn't meet the only home test by the sounds of it, but depending on the number of days you're here and your ties to the UK, you may trigger UK residence under our statutory residence test. So secondly, we would then look at, well, are you resident in the UAE under their rules? Now, I'm not an expert on the rules in the UAE, but my understanding is that if you're there for 183 days, or if you're working or have a home there, you're limited to 90 days, but correct me if I'm wrong. So there is a possibility that you could also then be resident in the UAE under their rules. So this looks like we might have a dual residence situation. I think the other country was South Africa. So again, you'd need to also look at the rules in South Africa. So you could even have a triple residence situation. It's very, very unusual, but let's just focus on the UK and the UAE at the moment. So then we would look at the tax treaty, and we would go through the tiebreaker tests in order. So you wouldn't, your residence couldn't be determined under the first test, which is the home test, because there's a home in both the UK and Dubai. So then we'd look at the centre of interest test, and it's most likely that residence could be determined under that test. So it would depend on the specific situation and where employment is, what the assets are, where your assets are, what income is being derived, where the main sources of your income are, where your family are. That's given quite a lot of weight for the centre of interest test. So we would have to go through all the steps, do the full analysis, and then come up with an opinion as to which country you should be treated as resident in. It's not always straightforward, particularly when you get to the tax treaty, because there's no real kind of hard and fast definitions. We have to rely on the OECD model commentary as to what kind of things the tax authorities would look at, what they've agreed to look at. So it's not necessarily clear cut. It can be a bit of grey area, but we would have to do the full analysis.
Okay, great. Okay, we've got another question coming here. So If I become a UK resident, but I don't qualify for the FIG regime, what other tax planning can I do to minimise my liabilities?
Should I take this one in turn then?
Please.
So yeah, it really depends on what their source of income, what their assets are. They currently held personally or in some sort of vehicle. Where are they, overseas or in the UK and so on. It's quite popular in the UK now to have, as you know, Alex, offshore bond wrappers, which can allow the deferral of income and gains within the wrapper until you withdraw it out. So that's quite a popular vehicle. Obviously, that only really works for sort of standard type investments. So again, it sort of depends on the type of investments you've got. But that's the sort of stuff you'd be looking at for sort of cash and quoted investments. For other investments, you could look at, rolling it up within a company or something like that. But there are some anti-avoidance rules there if that's going to be an overseas company. And if you use a UK company but plan to relocate back overseas at some point, then that it is not ideal. It depends on what else what you're doing in the UK. You can shelter tax through EIS and SEIS. There's a sort of a variety of different things that can be done, and potentially it could be a combination of a few things. But we really have to look into the specifics for the clients again.
Okay. Here's one that comes up quite a lot, actually. So how do they actually know? So how do HMRC check the tax residency?
This is one that we get asked quite a lot.
Yeah.
Well, I mean, nowadays there's so many ways that they can check tax residency, and they would ask for lots of information. So the starting point would be passports. They would they can ask for credit card statements, bank statements, which show where you are on any particular day, where you're spending money. They can ask for utility bills. So if there's quite high utility usage, for example, and they can even get down so far as asking for things like emails, particularly in relation to work situation, work diaries, that kind of thing. So there's a lot of ways that they can check where you are on a particular day. And they can look into it in quite a lot of detail if they want to.
Okay. So if I was to become a UK tax resident again, is there an optimum time as to when I should return? Is another question.
Well, yeah, as we mentioned, sometimes if you move partway through the year, then if you can, maybe try and defer it to the next tax year. So that's probably the only timing, and then also delaying it can then give you time to do some pre-planning. You can tidy up certain assets that may not be beneficial from a UK perspective. You could crystallize some income before coming here, rebase things for capital gains tax purposes and so on. So yeah, often maybe delay if you can, or at least pre-plan before that period.
Yeah, okay. And we've got a question from Sam. Nicole, when you were talking about being resident both UK and UAE, you said you could potentially be taxed as a non-UK resident. Can you just explain that one again, please?
Yeah, sure. So this is in circumstances where someone meets the residence tests, the UK residence tests, and also at the same time remains resident in the UAE. So they're dual resident under each country's internal domestic rules. So then we look at the treaty, and if under the treaty tests, that individual can be regarded as resident in the UAE under the specific treaty rules, then effectively they're taxed as a non-UK resident for most tax purposes. So that's what that means. So even though you're resident in the UK under our rules, the treaty would override that and say, no, you're resident in the UAE. Obviously, if you meet the tests and residence is determined to be in the UAE under the treaty tests.
Okay.
So one point to make on that is that you do have to claim treaty non-residence in the UK. So on your tax return, you'd have to say that I think so I am resident in the UK. I'm also resident in the UAE, but under the treaty tests, my residence falls to the UAE, and you would have to declare all that appropriately in the UK and any income and gains you're relieving from tax on that basis.
Okay. Question from me. We've kind of spoke about the UAE, but there's obviously a number of different countries in the GCC that have also been affected by this situation right now. Have you got experience with Qatar residents, KSA, Saudi Arabian residents, etc.?
We've got experience of everywhere in the Middle East, really.
Right.
Obviously, the UK side is consistent, but the other side, we may need to call on our sort of network there. Just to add on the treaty question a moment ago, that will actually be very relevant to a lot of people who've returned to the UK.
Yeah.
And although you could be regarded as sort of non-resident for the purposes of the treaty, it doesn't necessarily cover everything to be not. It doesn't mean you're non-UK tax resident under our domestic rules. So there could be scenarios where certain income is still taxable. It just means basically under the reading of the treaty you're non-resident. So sort of they're probably example, an easy one is if you've got a UK employer and you're non-resident, it's broadly not taxable. But if you are and treating non-resident, that it can still be taxable to an extent. So you still need to be quite careful there. Again, it's just a sort of more detail.
Okay. We've got one final question and then we will wrap up. We've been going 47 minutes. Okay, so if I rent a property in the UK temporarily, does that count as a home? I think it does, doesn't it? From what you said.
Yeah, well, it depends how temporary. Well, it depends what they're talking about. Yeah, is it that for the accommodation type or the home test?
Right.
But yeah, probably either. It depends how temporary they mean. But yeah, if it's sort of a short-term Airbnb type thing, then possibly not. But if it's sort of longer term, then yes, it would do.
Yeah. Okay. All right, guys. I think we'll wrap it up there. On behalf of Holborn, obviously, the Lubbock Fine team, thank you very much, David and Nicole and the team over there for assisting, putting together a great presentation. From our perspective, it's obviously hugely important that you take professional advice on your residency, either when returning or leaving, to ensure that you do it correctly. And anything from you guys to finish?
Yeah, so thanks very much for having us, Alex. And
you're welcome.
And yeah, if anyone has any questions, please feel to reach out. You know, we do a sort of introductory call with you or a client directly for free, and then after that, we can sort of scope out any work and so on and provide a fixed price. So, depending on what it is, we can agree a fee for that. I just saw someone mention that in the Q&A. That's just why I mentioned it.
Good. Thanks a lot, guys. Thanks a lot for your time. I wish you all the best, and I'll see you soon.